Hey, what's up, guys? Welcome to the stream this evening. So today is going to be a little bit different. We are basically just going to be talking about some stocks that I'm kind of looking at right now, and I'm just going to kind of be walking through some of the things that I normally do when I am, doing research on a stock, analyzing a stock, stuff like that. So hopefully that's interesting to everyone, and we're just gonna kind of go through some stuff. If anyone does, have any specific stocks in the that they want me to look at as well, we can talk about those. I can, look up some information on that as well. So just let me know, what is interesting you, and we can look at that. But for now, I'm just gonna start looking at these companies. So these are going to be real estate investment trusts that we're looking at here. And I am going to be basically looking at some REITs. So I'm kind of interested in the storage unit REITs, I guess, at this point. And so I kind of have a list of a few of them that I'm going to look at. So the first one here is called PSA, Public Storage. So the first thing that I like to do is just to look at it on Seeking Alpha. So we can do that right here. Just look at the kind of company profile on Seeking Alpha just to get an idea of the company a little bit and understand it a little bit. So right now we're just looking at that. We're going to look at the dividends here, and looks like my internet is struggling a little bit, but that's fine. Good to see you, Rich. Welcome to the stream. Glad you could make it. So right now we're looking at PSA, which is a public storage REIT. It's just called public storage, but it's a storage unit REIT, I guess. So looking at the dividends, right now they pay a yield around 2%, 2.25%. And the unfortunate thing about PSA is that they haven't really been growing their dividend that much over the past 5 years. So over the past 5 years, it's grown on average about 0.5% per year. So we can look into that a little bit more by looking at the dividend history. And what we see here is that basically they paid a special dividend, at the beginning of August here. Just a few weeks ago, they paid this special dividend. But aside from that, they have not raised their regular dividend since 2017, it looks like. So they've been basically paying $2 per share per quarter, or $8 per share per year for a while now. And so unfortunately, there's just not much dividend growth there. And that is kind of a big red flag for me as an investor, is something that I don't like to see. Another thing we can kind of look at is the financials. So this is going to give us, an idea of the income statement. And hey, Sarah, good to see you here as well. So this is going to give us an idea of, whether their business has been growing or not. So first, looking at revenue. This is, December, basically the past 4 or 5 years. So we can see their revenue has generally been growing a little bit every single year, which is actually a pretty good thing to see. So, December, or as of 2017, their revenue for the year was about $2.7 billion. And now, 5 years later, it's about $3.5 to $4 billion per year, which is definitely a good thing to see, for sure, that they're able to increase their revenues. Their operating income as well is increasing a little bit. For REITs, operating income and income in general isn't as important to look at, just because of the real estate nature of their business, I guess, and the fact that they are, constantly reinvesting and acquiring properties. Let's see. I actually don't normally look at Seeking Alpha. So these are the kind of things we want to look at for REITs, which is funds from operations. So we can see funds from operations pretty steadily increasing. Obviously, they had a small, or this is adjusted funds from operations. They had a small decline in 2020. And let's see, they don't have the adjusted funds from operations payout ratio, but they do have the funds from operations payout ratio. And we can see that their funds from operation payout ratio is in the 70 to 85% range, generally speaking, which is definitely pretty healthy, generally speaking. That basically means they have plenty of room to pay the dividend. And then we can also look at adjusted funds from operation per share, AFFO per share, which is generally a good metric when looking at REITs as opposed to earnings per share. So that has basically generally been increasing a little bit. Obviously, we saw a little bit of a decrease again in 2020, but in 2021 they quickly recovered to levels much higher than before, which is definitely a good sign. And let's see, that's kind of all I would look at on this page, at least for a REIT. In terms of the balance sheet, we can definitely look at the balance sheet, which is good to see. Obviously, we're going to expect them to have a lot of debt. Like, that's not really going to be too rare to see some debt. But first, what I want to look at is total real estate assets. And we can see at the end of 2017, they had about $9.2 billion of assets, and today they have about $15.5 billion of assets. So that's fantastic, really, to see that over the past 5 years, they've been able to, increase their real estate assets by about 50%. I know some other companies have been increasing much more quickly, like one of the REITs that I invest in currently is Store Capital, and I'm not sure of the exact numbers, but I think they've probably increased their total real estate assets by like 100% in the past 5 years or something like that, which is pretty impressive in my opinion. So we can see they have some cash, not too much there, but total assets again have generally been increasing over time, which is good to see. And total liabilities, you're going to expect those to increase as well. If we look at the debt has increased significantly over the past year or two, which makes sense, I think, because we can see their total real estate assets had a big jump from 2020 to 2021, and similarly, their debt also had a big jump that year. So that was probably just financing, I guess, for those assets that they acquired. I also like to look at, the investor relations page and see what they have to say. So I'll look that up right now and show you guys what that is showing, because I do like looking at investor relations, and especially with REITs, normally they have some pretty decent information, at least REITs do, on investor relations to share with their shareholders. So let's see what we can find. We're on that investor relations page now. So they had a presentation from around May 2020. Oh, I guess this is May 2021. That's weird. Oh, I'll look at the company update from June 2022. That should be helpful. And then maybe the earnings release and financial supplement as well, because that's normally, that should be helpful as well. And so let's look at the company update. Let's see what we can find. Self-storage industry leader. This is interesting, these public storage buildings. I don't know if these buildings they're showing here are their offices, or if these are actually like their storage facilities, which is kind of interesting, because usually I guess the public storage units I'm used to are just kind of like basically like lockers or garages that are, they don't really have a interior. It's just kind of a exterior of a building, and you have your own key and stuff like that. But I don't know, maybe they have something else. So looks like they've been in operation for 50 years, 2,800 properties, 1.8 million customers, 39 states, 200 million rentable square feet of real estate, which is pretty good, I think. 23% portfolio expansion through $7.4 billion of investment since the beginning of 2019. So that's kind of what I was talking about with that big jump in assets in the last few years. And let's see, half of the US population lives within a public storage trade area. So that's pretty good. I mean, that's half. That's not like all that much given the fact they're in 39 states, but I don't know. Let's see, capacity to fund further growth, sustainable growth, ESG. I don't really pay attention to that too much if I'm being honest. But let's see. They say their income generation outpaces and is more resilient than the broader real estate space. Same store net operating income growth, 4.4% compound annual growth rate compared to 2.4% for the core real estate sector average. I think that's pretty interesting, and I'm not sure why they use that metric, because oftentimes net operating income isn't, something used with REITs, but I'm gonna try to get a better understanding of how their business works, because I think from what I'm understanding, maybe they have sort of more of a store, and employees that work there. So let's see, they have a mobile centric, so they have a website and maybe an app. You can sign digital rental agreements. So I guess it looks like 50% of their customers basically use this digital rental features, I guess, compared to other self-storage peers, which is, I guess, interesting. And then they have remote customer care, a mobile app, and they have digital property access. First company to 100% of properties with electronic locks and stuff like that. So I think that's pretty good, and see that innovation. Most, I guess, storage units I see are just, you have some sort of a key or lock. So I think that's good. Same store net operating income margin. So they have higher margins than other businesses in the sector that are similar to them. They're using solar power and LED lights to save on utilities. Let's see. So I guess they're just saying they've added more square feet than these other businesses, but I don't think that's really fair, because they are, the biggest. So they already, percentage wise, it may or may not be bigger than the other companies, and they chose a a time period that looks well for them, since they just made those big acquisitions within the past year or two. So that's questionable as to how much this specific metric or graph really matters. But let's see. So they definitely have a lot more debt since 2015, but they're saying debt and free cash flow fund significant external growth. $7.5 billion of debt issued at a 1.7% blended rate. Preferred equity has been refinanced at lower rates, $6 billion refinanced since 2015. Blended rate reduced by more than 130 basis points to 4.5%, which I guess is pretty good. They say their FFO multiple is sort of in line with other similar REITs, public storage REITs. So average annual contract rent for, I'm not exactly sure, rents gained from move-ins. 2 months ended May 31st. Average annual contract rent. So I guess this is just saying that they're, increasing rents year over year. I'm not sure exactly what these tables are trying to show. But let's see. We can see they actually have square foot occupancy. So their occupancy, I think this is square footage. So their occupancy, the amount of square footage occupied, is actually a little bit less in 2022 than it was in 2021. And this is contract rent per square foot. So definitely increased about 16 to 17% in 2022 versus 2021, which is a lot, it seems to me. Let's see. What else? So that's about it for this presentation. And let's look at these financial supplements. Oh, this thing is long. 2,800 properties. Let's see. So this is just saying revenues are increasing year over year for same store operations. Net operating income is increasing year over year. Funds from operation per share is increasing year over year. Dividends per share is not increasing year over year. Shares outstanding increased just a tiny bit, not that much, which that's one thing that you have to just know about REITs is they're going to issue more shares. That's one way that they, are able to acquire more properties. So that's just something that they do, is to issue more shares. They do have significantly more debt than they did the year before, but shareholders' equity is significantly higher as well. Income statement, let's see, funds from operations. They list adjusted? No, they don't. But FFO per share is 53% greater in the second quarter versus 2021. So definitely growing there. Let's see. Oh, I get what this is saying. So basically it's saying the tenants moving in during the second quarter of 2021 had a higher average rent per square foot in 2022 versus 2021. And similarly, the tenants moving out during the second quarter of 2022 had a higher rent per square foot than 2021. So that's interesting. I don't know. There's not really much interesting in this presentation. These are their results. DJ asked if I know anything about Forex. I know Forex trading is basically just like foreign exchange of currencies, but that's all I know really. I don't know anything about actually really what drives a lot of those swings in currency prices and stuff like that. And I really have no, so I'm gonna go back to this page. There's nothing else really on there. The one thing I also want to look at a bit, I guess I'll just look at a chart here of public storage. So let's see. Let's just go to Finviz. Hey, Jonathan, good to see you as well here. Let's just go to Finviz real quick, and we will see what the chart looks like. It is taking a little bit to load here, but looks like it has loaded. So we'll look this one up, PSA. My internet is definitely a little bit slow tonight. Sorry about that. All right, so we are looking at this chart here, and this is, the past 6 or 8-ish months. DJ asked my net worth. Honestly, I don't really know what it is right now. I don't think I really shared that on the YouTube channel, but um, I don't really track it that closely, at least at this stage in my life, so I can't really say, to be honest. But yeah, let's look at this chart a little bit here. We can see they had a big drop in at the end of April. I wonder if they were July, June, May. So they probably reported earnings at the beginning of May. So that probably wasn't what the big drop is. So I'm not really sure what this big drop here was, but they definitely recovered a lot. I like looking a little bit further out at this weekly chart, at least on FinViz. And I guess they have kind of just been following their, 50, I think this is the 50, which one? I guess this is just the 20. They've just been following the 20 period moving average here. And, they drop below of it. So honestly, I don't think much is going to happen, to the downside unless the whole market does that. Just because they kind of have this nice support historically along this 20 period moving average, which is pretty cool. But hey, Jonathan, so this stock is PSA, which is public storage. It's a public storage REIT, like they rent out individual storage units type things. So I'm just kind of looking at a few different storage unit REITs right now, and just kind of going through my thought process when I look at companies, and kind of what I look for. And specifically with REITs, I definitely don't have the most knowledge there, I guess. I've become more comfortable with. But yeah, that's what I'm looking at right now. I'm probably going to move on actually right now to the next REIT on the list, which is Extra Space Storage. So that ticker symbol is EXR. So let's see, looking for EXR here on Seeking Alpha, and let's just see what it looks like. Hey Bill, good to see Blue Collar Bill in the chat there. Extra Space Storage, and I think this one is a little bit more attractive from the dividend perspective. So the dividend yield is around 2.8%, so a little bit higher yield than the last one, but really not that significant. And if we look here, their dividend growth over the past 5 years has been 12%, which is pretty awesome. And they've been growing the dividend for 11 years, which I really like to see. So let's look at the dividend history as well, because that's something that can give us a better idea of how they've been growing that dividend. So if we look here, they haven't been raising the dividend. Well, I guess they have been raising it pretty consistently. So they raised it in 2017, then again 2018, 2019. It looks like they generally, the one thing I don't like to see here is they're not super consistent with when they raise the dividend. So a lot of times here they raised it in the second quarter. See, 2016 they raised it in the second quarter. Then 2017 they didn't really raise it at all. They just maintained it at this 78 cents. And then 2018 they raised it the second quarter. 2019 they raised it the second quarter. 2020 didn't raise it at all within the year, but then 2021 they raised it the third quarter, which seems kind of odd, and then they raised it the first quarter in 2022. So I don't know, it probably doesn't make much difference, but I like to see when a company has a consistent amount or timing of raising the dividend. But like I said, it's not that big of a deal. And if we actually look here real quick, I just want to calculate the amount of dividend increase. So if we look, let's see. So the dividend was 125 in 2021, and then they increased it to 150. So that's a 25% increase, which I think is 20%. Yeah, so that's a 20% increase, which is really awesome when you think about it. So honestly, the dividend seems pretty attractive. We can look at the financials again with EXR, which is something I usually like to do. So we can see revenues generally increasing around $1.1 billion in 2017, and now we're up to 1.6, $1.8 billion. in 2022. Operating income generally increasing as well, which is definitely good to see. And let's see, let's look for FFO. So FFO payout ratio is 66. It's pretty consistent, right around 60 to 70%. So I like that consistency in funds from operations, and the fact that they have been aggressively growing that dividend, but have still grown the funds from operations at the same level to maintain that 60 to 70% payout ratio is definitely attractive. Increasing around $590 million in 2017, now up to $974 million in 2022. And then, oh, this is interesting. Interest on long-term debt has gone way down recently, which is definitely good to see. You don't want to see a company when the interest is, really a hindrance to them and is, I guess, just causing them to struggle, and that's really weighing on them, the interest. Let's look to see if they list the debt here at all. I guess they don't list the debt here, but let's look at the balance sheet. They'll probably list the debt there. So total real estate assets definitely increasing at a good rate, 7.1 billion to 9.4 billion now. Total assets increasing at as well. And then long-term debt, 4.4, 5.8, 6 billion, 6.4. So $6.4 billion of long-term debt, definitely not increasing as much as public storage, which is not as bad a sign to see. And then also, like I said, they haven't had to pay as much debt back recently, it looks like. So this is kind of out into the future where they're not really paying on too much of it, which is probably why some of their interest is at a lower amount as well, which is cool. And Jonathan asks here, how often do I like to see a dividend raise? For me, I just want to see, ideally I'd like to see one every year, and I like to see that dividend raise be the same quarter or around the same time, because then investors can count on that stability and consistency from the company. But in the case of, extra storage, we looked at the dividend, and like I was saying before, they didn't raise the dividend in one of those years. I forget. Maybe they did. I forget now. Maybe it was one of the other companies. But they didn't raise the dividend in that year. And so, yeah, so here in 2020, they didn't raise the dividend at all, which is obviously not ideal, but it's still okay because that's still more that they paid in dividends in 2020 than 2019. So it still counts as a dividend increase, or a year that they increased the total amount of dividends they paid. So ideally, short answer is I like to see a dividend increase every year, and that, it doesn't really matter when that dividend increase is, but as long as it's, I guess, consistent. I don't know what Dr. Drip is talking about. Frank got banned. Maybe he's just talking about the, internet being poor. I don't know why. I guess my internet's just being poor right now and not that great, and it's kind of buffering, which is certainly not good. And looks like it's kind of fuzzy as well, which kind of sucks, but I think it'll be all right. It's not the end of the world. So let's see, what else was I looking at here? I think we looked through a decent portion of the balance sheet here. And let's see, liabilities increasing, equity is increasing as well, which is pretty good to see. I like that for sure. Net debt. Let's see where net debt. Yeah, net debt is. This is actually pretty interesting. They have 4,000 employees, which I did not expect at all for a company to have that many. At least this company to have that many. I didn't think this company is really that big. Let's see what their market cap is. That's something I don't really look at too much. Yeah, it looks like the stream is having trouble. I'm not sure why that is, but hopefully it will catch back up here, but I don't know. I'm just gonna keep going, and hopefully you guys can see some of it. I guess I've never done a live stream, I guess, from home. Usually it's through, when I have other people on, it's through StreamYard, which is another platform, but now I'm doing it from my computer. So maybe that's having some effect. But if we look at the market cap here, the market cap for EXR is actually $30 billion, which is definitely higher than I thought. And the price per FFO is 25.4 right now, which is not, doesn't seem that great to me. They're up 22% year over year, or sorry, I don't remember if that was year over year or year to date, but up 20% in the last 8 to 12 months is pretty good. So let's see, where's the price per AFFO? So price per AFFO is around 26, and it says here the sector median for price per FFO or AFFO is 17, so definitely a little bit expensive there. I guess we can go back to PSA to see where they're at there in terms of the price per FFO. So PSA is at 25, so really about in line with where EXR is at. The thing I do like for sure about EXR is the dividends. They are definitely stronger, and I think the company is growing at a similar pace as PSA, but the dividend history is a lot stronger, and this company is trading very similarly to PSA in terms of the chart, so that doesn't really do, but let's look up their investor relations page and see about the company more from the investor relations page. Something I normally do as well when I'm looking at stocks, but usually that doesn't work very well or quite as well with REITs, so that's why I'm not doing it here. But that's not the end of the world. I do like doing DCF calculations. They're pretty fun. Let's see. Let's see what's going on with their. So they reported second quarter results. Having trouble with the stream here. I'm not sure why that is, but it's just not working for me right now. So maybe I'll have to try to look into that for future streams. But I guess we'll just try to keep looking at EXR for now. So let's see here. They announced their second quarter earnings. So same store occupancy of 95.9% as compared to 96.9% in 2021. So pretty similar to what we saw from PSA. Is a little bit lower occupancy this year than last year, which is interesting. So in the quarter, they acquired 12 stores and operating and 3 at completion of construction, and completed 1 development for a cost of $231 million. They're in some joint ventures, which acquired 16 stores, of which the company invested $57 million. added 40 stores to the third-party management platform. Company managed 864 stores for third parties and 304 stores in joint ventures for a total of 1,168 managed stores. So FFO per share was $2.12 for the quarter, and net income per share is $1.73, which is a 38.4% increase compared to the prior year. Quarterly dividend of $1.50, we saw that already. Originated $70.3 million in mortgage and mezzanine bridge loans and sold 44.7 in mortgage bridge loans. Let's see, let's look at some of these tables. So definitely an increase in net income per share there. Funds from operations saw a nice increase from 303 million to 232, from 232 million to 303 million. And the number of shares grew a little bit, but really not that much, so that's not that big of a deal at this point, I think, which is good. Seems about as healthy as PSA, probably a little bit better than PSA in my opinion. But the other thing I really like about EXR is their that they do have, you know, such a great you know, dividend history, and have been increasing the dividend pretty quickly, you know, over the past 5, 10, 15 years. So that's definitely a plus for me, and one of the best, really one of the best things that I see in Extra Space. So that's kind of what I'm looking at right now. Unfortunately, the stream has been a little bit buggy. I'm not quite sure why. It actually looks a lot better now, which is interesting. So I was gonna actually end it, but I'll probably keep going since it looks like, you know, it's actually looking good right now. So the next company that I was going to look at is called NSA, National Storage Affiliates. So we'll look that one up and see what we can see from NSA. So let's see. Let's look at the dividends page again. And NSA, first off, has a higher yield than the other ones, about 3.8%. The other REITs were, you know, around 2.5%. Hey Jay, good to see you're still here. Sorry about that lag and stuff like that. I'm not sure what's been going on. I haven't really had problems with this before, but I don't know. Again, I don't know what's happening, but you know, from what I'm seeing, it looks like it's doing a lot better right now. So I'm just going to keep going, and hopefully it, you know, continues without much of the lag. But like I was saying, dividend yield about 3.8%, which is significantly higher than the other ones. And they have been growing the dividend at a rate of 15% over the past 5 years, which is really awesome. 15% per year, that is. But they have only been growing the dividend for 6 consecutive years. So let's look at that a little bit more closely. So we can see that, and going back, you know, 6 years. So basically it looks like that's when they started paying dividends. I'm not sure when they went public. I would have to look that up. But let me actually look that up right now. Let's just try to see if we can, you know, figure out when they went public. But right here, just looking at the dividends again, basically they looks like they paid started paying a dividend in 2015. So pretty much they've been increasing the dividend ever since they went public, which is definitely good to see that they've been, well, I don't know if it's since it went public, since they started paying the dividend, but they have been, you know, consistent with that, and they have been increasing it, you know, multiple times per year. So in 2016 they increased it the second quarter, then they increased it the fourth quarter as well, and then same thing, 2017 they raised it twice, 2018 they raised it twice. So I think that's kind of cool that they raise it, you know, twice every year, once in the second quarter and once in the fourth quarter generally, and then now they've gotten a bit sporadic. And but generally they're increasing the dividend super quickly, which is awesome. And Jay said, just as you said that, you lagged out again. By the way, Charger greater than Challenger. Sorry. Well, I don't know. I have to disagree with that, but my brother actually has a Charger, which I mean, I'm not gonna lie, it's pretty sweet. So I'm not gonna say I don't like the Charger, but I personally like the Challenger a little bit better. And I just heard recently that Dodge is pretty much ending those new Chargers and Challengers. I like those a decent bit because they I don't know, at least the Challengers, they looked very similar to the old style that the new ones looked similar, I guess. So yeah, like I was saying, they have been increasing the dividends super quickly, which is really exciting to see. And if we let's look at the yield here over time. I'm sure it's just been going up and up and up because of how quickly they've been increasing the dividend. So let's see if this loads, which probably not going to because it's just doesn't want to load, I guess. Which is actually pretty interesting. So they reached above a 5% yield in 2020, but since then they've been down below 3% even, which is pretty interesting. Let's try to look at the stock price a little bit. So yeah, it looks like they went public in early 2015-ish, but in the last year, the stock has, let's look year to date. Year to date, they're down 14.5. I think the other REITs were not down quite as much, but I'm not sure on that. Market cap is only $5 billion. So this is one of the smaller companies that we've looked at, which, again, if a company is smaller, there's more potential for gains, I guess. But Rich also asked about BST or BSTZ. I'm not familiar with those ones. I think they might be, if I had to make a guess, they might be some sort of closed-end funds, but I'm really not sure. Maybe I'm completely off there. Let's see. I'll look them up real quick. Oh, it looks like this is a science and technology fund. Oh, it is a closed-end fund. Okay.